Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Scott Acheychek, CEO of Shares, to discuss covered call and single stock ETFs. Scott, it's great to see you again. Welcome back to Trade Talks.
Great to be here.
All right, you re-entered the ETF space in October with the launch of FEPI. Shortly after, you partnered with Total Capital Management to launch a single stock ETF called T-Rex.
Yep.
Can you share more about your return to the ETF space?
Yeah, I think the fun part about being at Shares is that we're not really looking for like the next great little bait idea, the S&P 501 or the Nasdaq 99.
Right.
We look at all markets, we look at all product types, and we just try to really find where there's interesting opportunities for traders and investors. So we reemerged in the ETF space, like you said. We were the first ones to have 2x and minus 2x single stocks, which we're very proud of, leading the way with Tesla T and Tesla Z, which is Nasdaq listed. And then from there, we looked to launch our first covered call strategy, which is on like a basket of like FANG and Friends.
So FEPI, how does that differ from other covered call strategies in the marketplace?
Yes, it differs greatly. So we're focused on the 15 stocks that are in a FANG and innovation basket. And our goal there is to sell calls on those individual names. So we're long the stocks and we sell the calls on the individual names. So what that does is that we're able to take advantage of the higher volatility on single stocks rather than on an index basis. If you think about an index, you have a basket of stocks, some go up, some go down. That kind of dampens the volatility. By just focusing on the single stocks, we're able to grab more volatility, which allows us to do two really cool things. One, strike the calls just a little bit out of the money to allow for price appreciation, which is something that covered call strategies completely have been failing at for a while. And two, because it is more volatile, we're able to kick off a very healthy distribution. Right now, we're distributing over 25% per annum.
Of course, I have to throw macro in here, right?
Yes.
So how does FEPI, how does it fit in an investor's portfolio considering the interest rate environment we're in?
Yeah, well, I mean, when I look at the interest rate environment, I mean, I just see prognosticators being wrong year in, year out, whether it's rate hikes or rate cuts.
Look at a rate of 10 years.
Yeah, exactly, yes. So it's just like there's this interest rate volatility right now, which is opening the door for these alternative income strategies. So there's a lot of people that are just moving some of their bond portfolio and moving into something where they're more comfortable. Like for FEPI, you need to be comfortable with big tech. Well, you know, it is about half of the Nasdaq 100, these 15 stocks. It's about 30% of the S&P 500. So if you're kind of comfortable from a risk-reward standpoint of those stocks, then you can be pretty comfortable with a FEPI covered call strategy.
What about T-Rex, right?
Yeah.
Clearly it's concentrated in one
Yes.
stock, it could be 200% either way, right? So how does that kind of exposure work for, like, what kind of investors would that be appropriate for?
Yeah, so it'd be almost the exact opposite of what FEPI is, right? So we have a number of products under a brand called Microsectors, and our goal is to really provide trading products as well. So I mentioned that before, we're just looking at different markets where we see opportunity, and there's a couple holes in the marketplace for daily trading products. So T-Rex is just that, 2x Tesla, 2x inverse Tesla. These are things that should be held for a couple minutes to a couple hours. It needs to be really monitored closely by active traders. This isn't something you ever want to buy and hold, but something you really want to have if you have that like strategic piece of your portfolio that you're actively trading.
So you have Tesla, you have Nvidia, Apple, Alphabet, Microsoft.
Yeah.
How do you determine which stocks you want to create these ETFs around?
Yeah, just where there's interest. You know, what are people following the most? What stocks have, you know, a tremendous, let's say, social velocity that people are like following their earnings to a ridiculous degree? Like, right. I listen to a podcast that's on whatever Elon Musk has done in the last week, right?
Right.
So wherever there's this kind of like interest where people may have like, you know, upside or downside views on the stock, that's kind of where we want to be.
All right, appreciate the insight, Scott. Thanks for joining us
Awesome
on Trade
being here.
Talks. And thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.